So Google recently reported their Q1 2019 earnings. By the way, I know it's Alphabet, but I refer to them as Google. So they reported their Q1 2019 earnings. And to put it mildly, Wall Street did not like what they saw. In fact, the stock is currently down about 10% since those earnings. And you might be thinking that 10% isn't that big of a deal, but for a stock like Google, it's actually pretty massive. In fact, just a 10% trim off their stock price puts them near the midpoint of their 52-week range. So that just goes to show how rare it is to be able to get a discount on a stock like Google, especially if you don't have an overall market correction or crash. And even then, you're probably going to see most other stocks get destroyed much worse than Google. So in today's video, I want to talk about the reasons why Google stock dropped, where I think the company is headed in the future, and if I think that the stock is a buy as a long-term investment, in my opinion, and if I plan on buying the stock anytime soon, because I'm currently not invested in them. I used to be, but I'm not at the moment. So we're going to talk about all of that and a lot more in today's video. I hope you enjoy it. Let's get started. What's up, everybody? My name is Ale and welcome to my world of stocks. As always, please do your own research, make your own decisions. I'm just sharing my opinion. But let's go ahead and start by looking at the stock and the reasons why it dropped, and then we'll transition to where I think the company is headed in the future. Now, they're currently trading in the $1,100 range after dropping by around 7.5% on earnings day, and then the stock continued to sink to about 10% down from those previous highs that they hit right before earnings. However, they are still up by over 120% in the past 5 years and about 12% so far in 2019, despite the recent drop. So why did they drop? Well, that mostly has to do with their Q1 earnings that came in lower than expectations. Adjusted EPS was actually better at $11.90 versus expectations of just $10.61, but sales came in lower by about $1 billion versus expectations, although it was still technically up year over year by 17% at over $36 billion, which is pretty massive. But the growth rate was also lower than last year, which was sitting higher at about 23% for this same quarter last year. Free cash flow, however, was extremely impressive, coming in at over $7.3 billion, which is an increase of about 70% year over year. And the funny thing is that I haven't seen too many reports even mention that, but all eyes on Wall Street really seem to be fixed on the deceleration of their sales and the revenue miss of substantial proportions. A whole $1 billion is a pretty big amount, considering that most companies don't even hit $1 billion in total. The real story, however, was that ad sales, which is their primary source of revenue, only grew by around 15% versus 24% the year prior, signaling further decelerations in their sales. That's really the alarming part, because competition in the ad space continues to increase and threatens the sort of duopoly that Google and Facebook have held for a long time. Now, Google does still remain top dog with a very commanding lead over everyone else, but their share of the pie is expected to drop this year, while Facebook might actually see a slight increase, and Amazon is outpacing both and starting to grow at pretty alarming rates, which you can see on this chart here. Full disclosure, Amazon is one of my biggest stocks, and with the rise of online shopping, I could see more and more advertising being spent on Amazon's e-commerce platform. In fact, Amazon is even challenging Google in the search market, as new reports are showing that Amazon has overtaken Google in product searches, meaning that people are searching for products on Amazon rather than just going through Google search. In just the past few years, Amazon has grown their market share of that particular segment from 46% to 54%, while Google has had the exact opposite experience, dropping from 54% to 46%. And given that less than 12% of global retail sales were even done online last year, Amazon's growth in product searches will probably continue to surge right alongside their growth in online shopping overall. Still, I can't help but feel that Google isn't really doing anything wrong. During the conference call, the CFO mentioned that last year's quarter had a major tailwind from currency movements that turned into a major headwind this quarter and will likely continue into the next. He also went on to say that the timing of advertising product changes can often have big impacts on year-over-year growth rates for specific quarters. So he's basically saying that because they'd rather focus on improving the experience for advertisers and users over the long term, the short-term growth trends might be a little bumpy, but ultimately they're focusing on the long-term health of their business, which is probably the smart move to make, I would have to assume. And even with Google's immense lead in the digital advertising market, they still have plenty of room to keep growing. In fact, the market is expected to reach over $500 billion in just a few years, with most of that value coming from search and social media, two areas that Google really performs very well in with Google search and YouTube video. I know some people would argue whether YouTube is technically social media, but I think most people generally consider YouTube as also being part of social media. Now, when looking at the global search market up until April of this year, Google comes in at over 92% market share without anyone else even being in the same universe. The next closest competitor is Bing, which is owned by Microsoft, but practically nobody uses. Even Baidu, which is the so-called Google of China, comes in at barely above 1%. Not to mention that video advertising comes in third in the ad spending market, and Google's YouTube video completely dominates that market as well. In fact, YouTube has even become the second largest search engine behind Google search, which you can see on this chart here, and it's only surpassed by Google and Google Images, but still well ahead of anything else out there like Yahoo, Bing, Facebook, or even Amazon. And YouTube has also passed 2 billion monthly users this year, bringing it even closer to Facebook's 2.4 billion MAU number. It also makes YouTube a more popular Google service than even Gmail, and number one if you don't include search. And I really believe that YouTube is only going to get bigger over time, given how incredibly useful and entertaining the platform has become. Whether you're trying to be educated, shown how to do something through video, or just be generally entertained while you kill some time, YouTube has become a great resource across the world. And Google's dominance doesn't stop there, as they also dominate the global web browser market, with Chrome sitting at 63% market share, which is well ahead of Safari, Firefox, and Internet Explorer. And their Android mobile operating system barely comes in second place in the global operating system market, comes in second place to Windows, but that's only if you include all platforms. If you shrink it down to just mobile operating systems, which is really what Android is, it turns into an enormous 75% market share, which is well ahead of Apple's iOS, and there's really no other competitor in sight. Even then, these are just the markets that Google currently dominates, but if we look at how they're investing in their future, it gets even scarier. They continue to invest heavily in their cloud computing platform called Google Cloud, and while that is still estimated to have less than 10% market share, it leaves plenty of room for future growth, which they already seem to be experiencing, since the segment that it gets counted in, called Google Other Revenues, saw year-over-year growth of over 25% this last reported quarter. They also own Waymo, which is an autonomous vehicle company, and they already offer a commercial ride-sharing service in Phoenix that only launched about 6 months ago, yet already has around 1,000 customers using the service every single day. And while they still have a trained driver present for safety reasons, the company recently partnered with Lyft so that Lyft customers can choose to ride in a Waymo vehicle if they're eligible or where applicable. We're obviously in the early stages of this new venture, but there's no question in my mind that the future of on-demand ride services is autonomous driving, and that's going to be a huge market, in my opinion, in the future. And right now, Waymo seems to be making great progress, even though I still feel that Tesla is probably a bigger play on that. In any case, there are many other things that Google is investing in, like launching their own video game streaming service called Google Stadia later this year, and they're even trying to break further into the e-commerce market with YouTube after recently launching new trials where products get recommended with prices under the videos, and then a link takes you to Google Express where you complete the checkout. And it's already being tested by major brands including Nike. In any case, when going back to the stock, I do acknowledge that the valuation is still maybe a little bit high even with the recent dip, as their trailing PE ratio is sitting at almost 30. But I'm still convinced that a forward PE of 21.7 and a PEG of 1.6 is more than reasonable for the enormous company you're getting in return that still continues to grow at some pretty nice rates. Looking at the past 4 years, they grew their sales from 75 billion in 2015 to as much as 137 billion in 2018, with growth rates of 20%, 23.3%, and 23.4% for each of those years. Their profits have also been very impressive, as they brought in as much as $31 billion of net income last year alone. And we haven't even mentioned one of the best parts of Google, and that's their massive, absolutely monstrous balance sheet that has cash, cash equivalents, and marketable securities sitting at a massive $113 billion. That is a lot of money there. Now, their current and total assets are also extremely high, sitting at $138 billion and $245 billion respectively. And this is all with very little debt or very little liabilities, as current liabilities sit at only 35 billion, long-term debt at just 4 billion, and total liabilities at just 62 billion, leaving them with fantastic current and total ratios, both of which are sitting very close to a ratio of 4 respectively. Not only is this an enormous amount of money that they can use to keep fueling future growth, but if they ever decide to start paying a dividend, this would probably turn into one of the most exciting dividend paying companies in the world that could easily fund yearly payout increases for decades. So in conclusion, I love Google. I think Google's a fantastic, amazing company. It's a great stock. And I really, in my opinion, I feel that it's a buy on this dip and really any other dip, as long as the horizon is for the long term. Having said that, I'm not currently invested in Google, but I definitely want to be. And I probably will be invested in them in the kind of near future. The only issue I have with Google is that the share price is so freaking high. It's like north of $1,000. And some of my biggest stocks like Microsoft, Disney, Alibaba, Amazon, especially Amazon, those all trade at very high share prices as well. So if you guys know me, you know that I like to buy stocks little by little in small amounts that fit my monthly budget over time. And so it's difficult for me to invest in some of these companies that have really high share prices with the little portion of my monthly budget that I put into stocks. So for those reasons, I would need to get fractional shares, and you guys know that I love to use Robinhood because it's commission free. There's also M1 Finance, which does have fractional shares, so I probably will use M1 Finance to buy Google stock whenever I do. But, and this isn't a video about M1 Finance, but I'm just not really a fan of M1 Finance. I don't like the user interface. I feel like it's unnecessarily like complicated, and they try to like force you to use this pie system, and I don't know, it's just a mess. If you've ever used M1 Finance, then you know what I'm talking about. But it's not a huge deal. I'll still probably use it, but I just wish it was more like Robinhood. I feel like Robinhood is just so simple. The user interface is so clean, and it's very easy to set specific orders that I want and all that kind of stuff. But anyway, that's about it. So I probably will be buying Google stocks soon, and when I do, I'll probably make an update and let you guys know. But over the long term, I am extremely bullish on this company, and I just think it's a good one for the long term. And all the markets, they're going to be dominating many of them, and they're firing on all cylinders. So anyway, that's today's video. Hit the like button if you enjoyed it. Leave your thoughts and comments down below. I would love to read them, and I'll catch you guys in the next video. Take care. Bye-bye.